Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, May 16, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. You can see a purple line running across the top of the screen. That's been on there for quite some time, but we couldn't see it before because the market was at highs and you couldn't see the line on the chart because we hadn't got there yet. But that is $240.50, that line is. And today's high was $240 and I believe 66 cents or 67 cents, pardon me. 240.67 was today's high. As soon as we hit it, we pulled back. So let's take a look at an intraday just to get a sense for what happened when we hit the upside target. And you see that we pierced right through it, and immediately the market put in a sell off that number, off the $240. Actually, I had $240.55 was the number. So that was the number that I had calculated a long time ago, put it up there. Our zone was 240.50 to 241. I don't think we're necessarily done with the upside yet in this particular move. So for example, I had mentioned before, once we get to the 240.50 level of 241, that we're likely to have not the bigger correction, but a corrective move off of that price level. I still think that's possible. However, we're in options expiration week. Let's go back to the daily chart for a second. We're in options expiration week, and tomorrow is Wednesday, also known as Whipsaw Wednesday. So we can expect the market to move in both directions tomorrow. We'll be up, we'll be down. We may be up and down 2 or 3 times during the day. That's typical for a Wednesday during options expiration week. Not every single options X. However, it does happen quite a bit on Wednesday. So it'll look like the market's doing one thing and then it'll do something different. And remember, it's the job of the professional options traders at the big financial institutions this week to make as many options contracts expire worthless as they can for those retail traders typically that have purchased an option and they're on the other side, meaning the institutions are on the other side. They're selling a call where the retail trader is buying a call. The retail trader is buying a put, and the professional option trader is selling the put. So when the professional is on the other side of the trade, you have to kind of scratch your head and think twice and say, which side would I rather be on, the professional side or the retail or average investor side? Well, I would certainly rather be on the professional side. So selling a call, selling a put is absolutely the better trade if you're an options trader the majority of the time, because you have time on your side as opposed to purchasing an option, whether it's a put or a call. Time is working against you. So that's one of the reasons why you'll find that the pros tend to sell puts and sell calls as opposed to buying them. So where does that leave us? It leaves us back into Wednesday, where we can expect the market to be somewhat whippy, but the upside objective, or I shouldn't say objective, at this point we've met the objective, but I still think they're going to push the market to 241, maybe a slight pierce through 241 up to 241.10, 241.25, something like that. I'm not really expecting much more than that. At that point, I do think that the market is, for the most part, finished with this move for the time being. My expectation would be we would see a more meaningful decline off that number than, for example, what we saw today, which was just, 10 S&P handles, $1 in the SPDR. Not a big deal one way or the other, but I think we'll get a more meaningful decline off of the 241 level, or at the very least, at the expiration of options expiration, which is Friday of this week. They'll probably hold the market up at least through tomorrow, possibly through the remainder of the week, at which time I expect a little bit of a more meaningful correction, but not the correction yet that we're looking for in the second half of the year. Not just yet. Remember, the market's grinding higher here, and this is not necessarily a sign of strength, meaning it's unlikely we get a spike higher out of a pattern like this Okay, we're more likely to get a spike higher out of a pattern that looks, if you have a bullish pattern like this, and then another move like this, you're likely to get another up move. Okay, but the move that we're making here, which is we're just kind of meandering about in the upward direction, it's still a bullish market in terms of the spider, the NASDAQ. It's still bullish. We're above all the moving averages. There's nothing wrong with the market from a technical perspective. This pattern just isn't necessarily a signal or a sign that the market has a lot of upside in the tank. And that's really what I'm trying to explain. That's all. The other thing you want to look at to see if there's institutional participation in this up move at all is you look down at the volume. So I'm looking down here at the bottom of the screen, and you can see here of late the volume has been extremely light as we've been grinding higher. That's not a sign of strength. It doesn't mean the market can't go higher. It just means that there's no institutional participation in the upside. There's no conviction by the institutions. This is just very light volume, and that's not necessarily a sign of strength and not a signal that there's a tremendous amount of upside to come until we get volume backing an up move. That would mean institutional participation. That's a different story, but that's not what we have today. So that about wraps the spider. It's basically the same story over and over again. I just think they'll probably pop the market up another $1, another 10 points in the S&P, in that neighborhood, and then that's going to be about it for this move, in my opinion. Looking over at the IWM was basically finished near flat today, up 10 cents, less than 1/10 of 1%. We're not going to make anything out of it because the market was basically flat. They had a down move earlier, finished basically on the 20-period moving average, but we're in the same place we were yesterday for the most part, so there's no new information. This is still a bearish pattern. So there's no confirmation whatsoever with the IWM, confirmation that we're going to see the next leg of the up market starting right now, because the IWM is still making a bearish pattern. We're not near, as we are in the spider, the all-time highs. So therefore, you have to be a little bit weary when the leading indicator, the leading market indicator that I like to use, obviously the IWM and then the transports, when the leading market indicator is not confirming the upside in the market, you have to be weary that the upside is limited, and that's basically where we are today. So no change in the IWM. Let's move along, and we'll go over to the transports. And in the transports, again, same routine as the IWM. The transports and the IWM are trading very similar of late. There's been not a lot of movement today, or there wasn't a lot of movement today in the transports. We're down 4 points, basically flat for all intents and purposes. We're trading below the moving averages, the 20 and the 50. And until and unless we can get above those moving averages, that's going to contain the transports. If, and they are, the transports are a leading indication of strength or weakness in the market, we have to say this certainly is not a sign of strength. Nothing's breaking down just yet, but it's certainly not a sign of strength. So I'm watching the IWM, watching the transports very closely for signals, because I believe within days we're going to get a signal that the S&P is going to top out, at least for the short term here, and we're going to see several days to potentially a week or so of downside activity in the market. It may not be the end of the up move, but certainly I think we're going to stall out here on the upside shortly. However, looking over at the NQ, you wouldn't know it by looking at the NASDAQ. And this is indicative of the fact that it's top heavy that I always mention. And the fact it's top heavy skews the index. And that's why I don't use it as a leading indication. A lot of folks do, but I don't like to use it because of the quote-unquote top heaviness of the NQ. So if you think about it, the breadth of the market really right now is terrible. I just had this discussion with one of the members this afternoon, and when you look at a ton of stocks out here, and you can just pick the top 5 or 10 stocks in each sector and just take a look at the charts. Take a look at the daily charts. Very simply put, you can see it in a matter of seconds that you're hard-pressed to find a lot of stocks outside of some of the tech stocks, outside of the stocks that are driving the NQ higher, the NASDAQ composite higher. Outside of those, specifically retail and a lot of other sectors, are not confirming the highs in the market. That's never a sign of strength. In fact, it's a sign, when the breath is poor, it's a sign of weakness in the market. And while you can't necessarily, from a timing perspective, use that as a trading mechanism, it is something that I certainly pay attention to, and it is something that you should pay attention to from a larger picture perspective, and it is confirming what I've been telling you from a larger picture perspective, which is the second half of the year is going to be the bearish half of the year. We're going to see a decline in the markets in the second half of the year, and I'm not talking about 2 or 3%. I'm talking about a real correction coming, one that we haven't seen in quite a while, and it's likely to catch a lot of people by surprise. All right, let's head over to the gold market, and gold is up about $7 today, and you can see here we're headed to the 1242 level. Maybe we hit it overnight tonight, maybe we hit it tomorrow, but I think we're a day or so away from hitting the 1242, or potentially and more likely into the moving averages and this gap fill up here. So we'll call it 1250 for argument's sake. Could be off by a couple of dollars, but that's not really important. The point is that we've gotten it right in terms of the support at 1221. As long as that was going to hold, we should get what I call this an oversold counter trend bounce. Okay, the market was oversold, and essentially now the trend is down below all the moving averages. The short-term trend on the daily chart is down in the gold market, and therefore that makes this a counter trend bounce, and the counter trend bounce is likely to stall out, at least on a temporary basis, at the moving averages. If we consolidate around that area, we could certainly push higher. If that gets rejected in fast fashion, then we're going to trade back down to double bottom and potentially lower down to the 1200 level. It's very premature to start talking about that. However, we are headed higher right now, so we'll stay on that. 1242 at minimum, 1250 is probably the stopping point over the next day or so in gold. My expectation is we'll probably hit it at some point on Wednesday. Silver continued its rally today. Again, same routine with silver, and it's headed right to the 20-period moving average we discussed last night, which coincides with this red candle high at 1689. And this is also a counter trend bounce. Very oversold condition. We were down for 3 weeks in a row without an up day. One up day in 3 weeks. That's a very oversold condition. We're getting the counter trend rally, and we will stall out at the 20-period moving average, also coinciding with these pivot lows. We talked about it last night. No change, no surprise. This is where we're headed. We'll see what happens when we get there, but it should provide a pretty decent resistance point to the market. Tonight we'll bring up GDX. We'll talk about that for a second. And because gold obviously is on the rise, the gold miners have caught a rally, and we've caught a rally off this low, and we came to this gap fill here. This is about a 50% retracement. I haven't measured it. It's probably just a touch more than that, but it's close. 50% retracement, pivot high, pivot low, 50% retrace. Here's a gap fill, consolidation point, all this chart congestion in here. That's a natural area where any market will find a resistance or support area. Prior chart vibration, this is called, or consolidation, is a natural stopping point for the market, and here we are. So we'll see if we trade sideways from here. That could set up another move higher. Or do we get rejected? And if we do, that will most likely be because gold got rejected at its resistance point. We'll have to just see, wait and see. But this was a pretty good rally off that 21 level. I didn't necessarily think we would get up that high, but we did, and we retraced the rally, or retraced the move from pivot high to pivot low about 50%. I think it looks like it's probably somewhere in between 50% and 618. But nevertheless, that's a natural thing for the market to do. We've seen it before over and over and over again. Should come as no surprise that that is, once again, a resistance point for the market. Looking over at crude, we saw a pullback in crude today. No surprise. This same deal that we just discussed in GDX. Chart vibration, consolidation point, 50-period moving average sloping in. This is where the market found resistance yesterday. Tried it one more time early today, was rejected. Now we're headed back toward the 20-period moving average, but it's not uncommon for the market after a bounce like this from all the way down. The low was actually 43.76, and yesterday's high was at 49.66, and that's in 1, 2, 3, 4, 5, 6, 7. Wonder how that worked out. On the 7th day, we made a high and are now pulling back a little bit from low. So from low, 7 days later, we traded almost up into the 50-period moving average. This congestion point or consolidation point was a natural stopping area for the market, a resistance point. Now we're pulling back a little bit. We'll see if crude wants to put in a bullish pattern. If it puts in a bullish pattern, then maybe a trade there to the upside. We'll have to see. It needs more time. It needs at least 3 or 4 more days to see if that's what's going to develop. Also, forgot to mention, it's also around a 50% retrace from pivot high to pivot low. Pivot high here, pivot low, and this is about 50%. Same area as the chart congestion or consolidation. It's funny how that works over, and the same thing in here. That's the chart telling you that this price level is important. It was important here, it's important here, it's important here. So you have important areas on the chart, and then you have a 50% retracement. You have a 50 moving average sloping down into it, and when you have several things that all point to the same thing on the chart, it's generally something to pay attention to. When 3 guys tell you you're drunk, go sit down. All right, let's move over to the bond market. And we saw an uptick today in the bond market, but not really anything substantial. And while this 150.21 area is holding from a daily chart perspective, we didn't really get any kind of a meaningful rally off this level. And we're really putting in more of a sideways pattern. This is more bearish than bullish to me. We're trapped in between the moving averages. And so my expectation is we'll probably meander around a little more. And if the market catches a sell, for example, the stock market sells, next week sometime, for example, we may catch a bid in the bond market. But right now, there's really nothing to do in the bond market. And by the way, since I've talked about it on almost every chart we've looked at, might as well do it again. Pivot low, pivot high, 50% retracement, okay? Chart congestion, chart consolidation. It's the same thing. It doesn't matter what chart we're looking at. The same thing happens over and over and over again. Nothing's 100% of the time, but you can see when I start talking about the same chart patterns on different vehicles, different instruments, whether it's a commodity, whether it's a stock, the S&P, doesn't matter what it is. You can see just by today's video, it's the same thing over and over and over again. This is the way the market works. So when you begin to understand where the market should be expected to trade to, where it should find support, where it should find resistance, you find areas in the past where the chart was telling you that those price levels were important, you begin to put together, it's not that difficult. It's really right there in front of us to really just learn for ourselves by just visually looking at what the chart is telling us, what price is telling us, what time is telling us, what retracements are telling us. It all points to the same thing. Chart resistance comes in at generally the same places over and over again. Support, same routine, over and over and over again. So net, nothing to do in the bond market. We don't have a trade here. We just stay neutral to bonds for now. But there is something interesting developing in the dollar. Finally, We're finally coming down to the level that we've been waiting for, at least I've been waiting for, around 97. Maybe it's 97 and a quarter. Maybe it's 97 and a half. But once we get into the 97s, that's when I begin looking for a sign of a reversal. So we're basically there now. So I'm looking for signs of a reversal from this point forward. I'm looking to get into a long dollar trade for a long-term trade. This is not a week-long trade. This is not a day trade. This is not even a 2-week trade. This is a trade that I will most likely hold through or into the fourth quarter of this year. That's my expectation. Could be longer, could be shorter, but I just want to let you know, if anybody's interested in buying the dollar long, you can use UUP to buy the dollar if you want an exchange traded fund. You can buy you can short the euro, which is the FXE, is the ETF or the ETN that tracks the euro. And then there's an EUO, which is 2 times short the euro. So those are 3 ways that you can trade the dollar. You can buy options. You can trade the dollar itself as the commodity or as the currency. Anything you want to do, it's up to you. The point is, we're getting into the zone where you have to be looking for a sign of a reversal in the dollar. That's what I'm looking for right here, right now. And right here, we'll finish with that. That's everything I wanted to discuss tonight. So I'll leave it there. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.